This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Diane Crocker. For the week ending August 15th, despite some mixed signals in the inflation data this week, investors are still riding hopes that the Federal Reserve will start cutting rates in September. Manus, a hot wholesale inflation number reduced the chances of a jumbo cut, reviving questions about how much relief consumers can expect in the months ahead. But for now, it seems that the market is way more focused on the possibility of cheaper money than the persistence of higher prices.
It's a very funny market right now, I have to say. I've been hinting at this for a while, and now I think I'm going to go in full bore. I think that the market is exceedingly complacent right now. And I think that it's reflected not only in the low volatility numbers, which we'll talk about later, but when you see something like today, where the PPI number came in multiples higher than what people were expecting, and the S&P 500 is only down, 0.4% today, and treasuries are not really jumping around like you would expect after this. It tells me that the market is way, way too complacent right now. We are seeing stocks at all-time highs. We're setting new highs every single day. The markets are functioning fully, yet we've now seen two really nasty surprises. We saw a terrible jobs report a couple weeks ago, and now we've seen an alarming PPI number. And I don't know, let's separate for a moment the equity markets and CRE. On the equity markets, I don't know how people can continue to chase returns when we're seeing historically high PE ratios, extremely low volatility, record high prices, and nary a word about the threats we're looking at. And those threats are real. The possibility of a U.S. recession, the possibility that AI spending just dwarfs earnings for some of these real tech bellwethers, the possibility that inflation does reignite. I thought people would be much more frightened today than they were. And lastly, that corporate earnings are hammered because they have to pass through higher costs. We've seen that already from Ford and GM. So to me, I'm perplexed.
I wonder too, that complacency that you talked about, Manus, are people just so desperate for interest rates to come down? I feel like we're right where we were last August in a way, meaning the markets are treating a 25 basis point cut as kind of a done deal in September. I think any hope of a bold half-point move is off the table after the inflation data you just talked about. Beyond September, I think is anyone's guess, but I read this week that Goldman Sachs is expecting the cut in September, but then cuts after that. I think they cited 3 consecutive quarter point moves, and JP Morgan pulled their forecast forward too, projecting the September cut and then additional reductions because of the labor market softness and political uncertainty. And I feel like a lot of the perception is a market that's just so desperate for rates to come down. It's almost like they're hoping that they do, and it becomes a foregone conclusion.
I did promise that I would talk about CRE and U.S. equities separately. I am entirely risk off at this point on U.S. equities. The silver lining is I don't feel quite as concerned about the CRE markets, although there are concerns out there. The reason I'm not as concerned about the CRE markets, yes, the markets have been very active. We've seen the uptick since the beginning of the year in the LightBox activity index. We've seen surveys come out in terms of buyers, sellers, lenders, developers being more optimistic than they had been in the past. We see capital is plentiful. That's a great sign for the market. But the thing that really keeps me from being as concerned about CRE as I am about the broader market is that we haven't seen this euphoria in CRE in terms of higher prices. People are conducting business faster. Loans are taking place. Properties are being bought and sold. But we're not seeing that euphoria for example, that we saw in 2007 or that we saw in 2021 with multifamily properties. There's a soberness among buyers that is giving me great comfort that even if the equity markets get volatile and sell off, the reaction in CRE will be more like it was in April and May than it was, for example, in 2008 or 2015 during the oil bust.
Manus, underscoring what you were talking about, the complacency we saw, I think, in a number of publications as well as CNBC, the fear gauge is at its lowest that it's been for some time. And it isn't simply a measure of the fact that it's the middle of summer.
There was a reporter at the Wall Street Journal years ago. I wish I could remember his name. He followed the commercial real estate market. And he said at one point, and I love this quote, it's like the old detective movie where the hero comes out and says, you know what? It's quiet. It's too quiet, right? There could also be a Naked Gun reference in there too. That's probably something they'd say in those spoof movies. But that's what it feels like to me, that the fear gauge says nobody is terrified in the least. Bullishness is really high in the equity markets. I think that's the time where you hold on to your wallet. What do you think, Diane?
Yeah, it's interesting, Manus. I wanted to mention there was a tidbit that I saw this week, and it relates to what you're talking about. The tidbit was that for the first time since 2020, the 5 biggest real estate services firms, so that's CBRE, JLL, Cushman, Colliers, and Newmark, they all raised their 2025 outlooks in the same quarter. And that hasn't happened since basically COVID. And why? They're buoyed by stronger leasing, which is leading the recovery. They're encouraged by commercial real estate deals that are catching up, and they're hopeful that momentum could carry us into 2026. But what struck me when I read it was that the sense was that they're not blind to the headwinds, but there was kind of a sense among these big firms that the worst of the volatility is behind us. And that definitely syncs with the mid-year sentiment survey that we closed in July, where the majority of folks that we surveyed are expecting a busier second half. I spoke to a client this morning who said that Q3 and especially September after summer vacations, that's traditionally the time that there's a ramp up in transactions leading up to the fourth quarter. And his clients actually told him to take a vacation now because they're expecting a busy September, especially if rates drop.
What was really unique about 2025 so far is that we saw, for the first time, I would say, at least for the first time in a long time, a detachment. During that panic in April, when the equity markets were down 20%, there was really no sign of panic in the CRE side. Yes, we saw lending spreads go up, in some cases considerably, for CMBS, triple B minus, according to Morgan Stanley data, by the way. But we didn't see activity dry up like we did during past crises. But that's really the exception to the rule. The big question will come, if I'm correct, and the equity markets are frothy, and we do see a shock to the system in the last 5 months where we retest those lows of April, where the equity markets sell off by 20%, will the CRE maintain that stiff upper lip that it did in April? It was unique. We don't see that very often. I'm confident that it can for many reasons. I wouldn't articulate them all. I think that there's a good chance that it will shrug off broader market volatility, but it's by no means a slam dunk.
Let's turn to the LightBox data dive. Diane, we're going to turn to the July transaction data.
We are, yeah. We've been going deep into July's transaction data for a blog that's going live in a day or so. And so far this year, through the end of July, we've tracked a total of $160 billion in transactions for all of 2025. And that kind of reminds me of that tracker that they used to have on the McDonald's buildings when I was little, that number of billions of burgers sold. And so we've been looking at $160 billion in deals so far this year, isolating just the ones in July. the number of total deals above 50 million, they were up 10% in July, and we had already seen a surge in June. So that was very encouraging to see, especially given that we're in the throes of the summer season, which sometimes can be a little bit slower. So that jump really kind of mirrors the broader trend that we saw in the July CRE activity index, which was strong, came in just below June's high water mark.
I think this underscores perhaps why I'm confident that the CRE markets could shrug off volatility over the next couple of months, is that this activity, not only has it been picking up, and that's great news for everybody, but as your blog and your research has shown, Diane, the buyer pool is deep. This isn't a case where there's just a handful of big institutional buyers gobbling up everything. Every transaction and every month, we see a broad array of buyers out there. And the term I've used before is confidence. This is a confident market. People are confident in their ability to get capital for new projects or transitions from office to hotel or multifamily, and they're confident deploying capital. And it feels good right now in CRE in ways that it doesn't in the broader US markets.
Yeah, you bring up a good point. The more that I dig into the transactions data from your team, the more it's obvious to me that we're seeing very few repeat buyers, as you said, and that's important because it means every month we're seeing the net of investors coming into the market with intention is expanding, so they're feeling like, okay, we're going to jump in the pool as well. And as long as that continues, it's very encouraging. And it's happening, as you said, against a backdrop of a lot of uncertainty and the potential for the type of volatility that we saw in the market in April and May.
And the thing I love about this, and I'd love to hear from some of our listeners, if people want to ping us via email or LinkedIn or Twitter or things like that, feel free. It doesn't feel like people are paying up for assets. They are not reaching for these assets. And I'll look at the office market as the example. Even though leasing has picked up in certain markets like New York and San Francisco, those markets are still bouncing along near the floor that they set in 2024. There's no real irrational exuberance, to use the term that the Fed chair back in the 90s used. It does feel like it's a sober deployment of capital at the moment. What do you think about that, Diane?
I think I agree. And not to sound like a broken record, but looking back at the sentiment data, because that's fresh data from mid-July, from a broad brush of professionals across commercial real estate. And when we asked them what their expectations were for the second half of this year, I didn't see a lot at the extremes, meaning nobody's expecting a substantial increase in activity or a substantial decrease. They're huddled around the middle. Very few are expecting a decline, but the ones who are expecting an increase, it's a subtle increase. So it's not going like gangbusters. And I think that speaks to the fact that folks are hopeful that capital will still find a home in real estate, but nobody's, expecting irrational exuberance. And I think that's a good thing.
We do have a recent set of data that shows us what irrational exuberance looks like. If you look at the same type of data in 2021 and 2022, there was extraordinary evidence in two property types of people overpaying. One was justified, one was not justified. The justified was the industrial, mostly the warehouses and logistics centers. There you would see properties that sold in 2015 sell for 2x in 2021, but that's because demand was so high. People were clamoring for industrial space, and the rent increases justified that euphoria. Totally get it. Where it was unjustified was in multifamily. And there, what you were seeing is properties trading in 2021 at 40% premiums to where they traded in 2018. And that wasn't a one-off. That was over and over and over again. And whenever you see something like that happen, to use the same term I used 10 minutes ago, it's time to hold on to your wallet. And we saw how that worked out for a lot of these buyers in 2021. They're seeing their values down. They're seeing disappointing rent growth, disappointing valuations, and To the good, we're not seeing that right now, as far as I can tell, in any of the 5 major food groups in CRE.
Well, that's a perfect place, Manus, for me to thank you for all the data that you're collecting on transactions. That $160 billion in deals in calendar year 2025 gives us a way to drill down into asset class and see, okay, what's the average in the office sector in terms of the current selling price versus the prior selling price? Is it selling at a discount? Is it selling at a higher price? If it is selling at a discount, what's the average discount? And it'll be interesting to see. We're just really in the early stages of doing that. But at first cut, it looks like for the office deals where we had a prior purchase price as the basis for comparison, 54% of office deals are selling at a discount versus the prior price, compared to only 25% in multifamily.
And I think if you looked at industrial, I bet you would be low single digits.
I think so too. That's next on the list.
That's next on the list. But I got to pay it forward here. Thank you for the compliment, Diane, but I am only the vehicle here. I have a great team behind me collecting this data, cleaning the data, looking at it week after week. They do great work, and thank you for that great work.
And our Did You Know for the week is going to take us to our capital markets snapshot report, which was recently released. Diane, what does it tell us about listings?
We go deep into our property listings data for these quarterly snapshots, and I love doing that because it really offers us a clear window into the types of assets that are driving the most attention. And it's still multifamily. Multifamily listings increased their share of total listings in Q2 from 33% in Q1. So 36% of all listings coming on the market are for multifamily. The transactions data shows that multifamily deals are moving very briskly. We might see some impact on rising insurance costs that might challenge new development in this sector, but I think multifamily still very much sits at the top of the pile. So the report has more details by asset class. We have some encouraging data on the office sector, and we go deep into breaking down deals by size to see whether institutional capital is getting more active than private. And of course, we share our thoughts on how we think the rest of the year is going to shake out for investors and brokers.
If there's one reason to be less bullish than I am on CRE in the near future, it's what you just said, Diane. It's that insurance cost line item. That is a real concern. We're seeing things go up extraordinarily fast in many markets. And if there's something that could take the wind out of the sails, let's say over the next 6 to 12 months, that would be my biggest concern.
Let's turn to some of the noteworthy transactions we've seen. We're going to start maybe glass half empty, a couple of stories that are some steep discounts.
Well, we have one in the Pasadena office towers sold at a 50% discount. This is a 2-building complex in Pasadena. It had sold in the past for about $256 million. That's per Commercial Observer. That was $537 a square foot. The last sale taking place in 2016. This particular price down more than 50% to $120 million. The buyers there, Harbor Associates and the Roxborough Group. The seller, CBRE Investment Management. And what you're seeing here is the echo of what I said earlier, which is office valuations plummeted in some markets 80%, in some markets 70%. They really haven't bounced off that trough that they hit a couple years ago. And I don't think there's any expectation that they will, especially in the Class C, Class B, and Class A minus segments. The trophy office market doing quite well. Valuations have really rebounded nicely, but everything else, you are bouncing around on that trough. The bad news is probably no acceleration of valuations anytime soon. I just don't see that happening in most major markets. Maybe you'll get a bump in New York because leasing has picked up so considerably, but elsewhere, I don't expect it. The good news is that we are seeing a lot of transactions, which means there's a lot of transparencies. The market should clear, letting new owners come in, as was the case here, setting the stage for someday these valuations starting to come back. The first thing that has to happen is a clearing of the distress. And that's happening right now. And that's the one silver lining you could point to in this story.
Yeah, office is definitely on its way to the bottom, but not there yet. What was interesting about that story, Manus, is that that's an office tower deal where they sold at a 50% discount. And I just said that when I looked at our office transactions data, the average discount for office was 54%. So it's almost right on the money in terms of the average. And as the market kind of recalibrates, it'll be interesting to kind of watch if those average discount rates change or not. But to your point, office investment sales have surged in early 2025 in metros like LA. Greater LA's office deals reached 1.4 billion in the first half of the year, and that was compared to just 287 million over the same period of 2024. So to your point, the universe of buyers is ramping up, but they're buying at much lower valuations.
We had a podcast guest on, and I don't want to name this person because I'm not sure if the remark was on the record or off the record. So I'll keep it anonymous for now. But the person said, if I had an office today and somebody said, I'll give you 50% off the last purchase price for that office, the gavel would come down so hard and you'd hear that seller saying sold. There are so many comps right now. In Portland, right, you're seeing 85% discounts. In Chicago, you're seeing 85% discounts. That if you happen to get a 50% bid, I think in most markets, in many markets, you would do your happy dance. You'd be the happiest person in the world for getting that kind of bid. So just some perspective on what we're looking at office, even after 2 years of real price resetting.
And the next transaction takes us to San Francisco, where we've seen big hotels change hands.
Yes, this has been a long time in the making, a several $100 million CMBS loan backed by 2 hotels. This was really undone by the quality of life issues that took place in San Francisco. It was really a nationwide phenomenon in terms of the acknowledgement of this problem. Certain cities don't get the kind of attention that San Francisco gets. Smaller cities, you might not know that there are quality of life issues, but in San Francisco, it's unavoidable. It's part of the national dialogue. And here, that dialogue resulted in fewer people holding conferences, going to that city for vacations, and it was reflected in valuations of hotels and also the bottom line numbers of people that were coming to that city to stay. So, but San Francisco's not alone. At one point, high quality or even everyman hotels in New York were selling for $600,000, $700,000, $800,000 per key. During COVID, we saw that trough at $250,000 a key. Now, New York has battled its way back. Maybe it's a $450,000 per key market for a high quality hotel now. But that market, in places where people are concerned about crime, homelessness, it's a hard road back. Once a city gets stigmatized with quality of life issues, it takes an awful lot of time to change that narrative.
Yeah, Manus, it's a shame because I've attended a number of conferences in San Francisco. It's a beautiful city. I'm hoping it does make a comeback, but you have to think that a lot of eyes are on this deal because they're bellwethers for San Francisco's hospitality market. And if the sale closes, it could be the early sign of a start of a reset where maybe realistic pricing brings some of the bigger players back to the table.
Yes, this has been kind of dead lone walking for a while, but if there's a silver lining, and I keep using that term a lot today for San Francisco, is we have seen that uptick in leasing from AI companies, and that should be the first start of what could be a revival. If you get workers coming back to the city, even if it's 3 days a week, that should at least change momentum in terms of the city becoming a little bit more vibrant.
Okay, let's talk a little bit about financing. We saw a number of financing deals that are pretty interesting.
Yes, I like to talk about how the 4 pillars of CRE lending are functioning, and they are. This week's headlines really underscored that. We saw one story from Commercial Observer that Bridge City has lent $45 million for the development of Long Island City condos. This is one of maybe a half dozen stories that I highlighted for an internal meeting within LightBox where we talked about the financing market. And two takeaways from this particular story. Number one is, and this might be redundant, but capital is plentiful even for the riskiest types of assets. Construction and conversion, capital is available for people that want to put shovels in the ground. Another sign of a confident market. But the other side of it, when I went through this week's litany of just by account basis, it seemed like 2 out of 3 or 3 out of 4, the cash was coming from private equity. It wasn't coming from that traditional bank. It was coming from somebody who probably only started doing CRE lending in the last 5 to 10 years. And I thought that was very interesting. Now, there may be some bias in my numbers. I tend to look for stories where we are talking about shovels in the ground construction or conversions. I'm sure that the banks are very, very active in refinancing stabilized properties. But I was amazed at the number of times when it was a non-bank providing this financing. The other story that jumped out at me was that Clearline, they nabbed an $89 million construction loan for a 310-unit project in Wynwood. And here you have two lenders. This is not unusual. Maybe this is a little bit of an educational segment. In this particular case, we have the senior loan being made by Bank OZK. They are one of the more active loans in CRE, especially on new development. They provided the senior debt for this project, and they were backed up by PGIM Real Estate, who provided the mezzanine loan in this particular deal. So sometimes you see banks acting alone. Often that's for stabilized properties. Sometimes you see private equity working alone, especially for things that are outside the sweet spot for banks, things with more risk or higher LTV or more value add necessary than banks want to take. And sometimes it's a partnership, a bank providing the senior debt and somebody else providing that additional bridge capital to get the deal done.
And the last financing story is an interesting one. Disney's Cotino community has tapped a $160 million construction loan, which tells me that living the magic isn't cheap, Manus.
Well, Disney certainly isn't cheap these days from what I hear. I haven't been there in a long time since I had young kids. I always love going there. I know that there's Disney lovers and Disney haters, but it certainly isn't cheap. But I think in our prep for the pod today, you were talking about, are the princesses and Prince Charming is going to do double duty? Are they going to have to greet people at the entryway, do the special dining things, but also survey the property for these new projects? I know labor is tight.
Just bringing up images of looking out the window and seeing Donald Duck or Goofy mowing the lawn.
Right, a Prince Charming hopping off a white horse and pulling out his tape measure and his surveying tool. I think that would be one that would break TikTok.
Well, we joke, but I think it's this brand meets real estate hybrid. People want to live the Disney magic in their, $1 million home.
That could be. I got to tell a story. I'll take a detour. Maybe this will end on the cutting room floor. But it just shows how little street savvy I have. I took my young kids to Disney once, and a lot of time was being wasted on the autograph line. My kids wanted to get the autograph from Goofy, and you'd wait 15 minutes to meet Goofy, and my wife and I would get irritated. Come on, there's rides to be gone on. We don't need Goofy's autograph. And my wife told my kids that night, give me your autograph books. Disney has this plan where if you leave it outside your hotel room, the characters come around, sign it all, and when you wake up, all the autographs will be in your book. And me, being the idiot that I am, said to my wife, wow, they think of everything. And she says, no, you idiot, we're going to sign them.
That is brilliant. I love that.
My wife is so much smarter than me, but you would have thought something like that, even I would have been able to figure out.
And a programming note, next Monday, August 18th at 1 p.m., our very own Manus Clancy and Diane Crocker are going to be joined by Tina Litchens to talk about, Is the CRE market off course or on track? Caution, conviction, and course corrections. How's that for alliteration? So join us if you can. It'll be insightful in terms of what's happened through the first half and what we can expect for the second half of 2025. And in closing, you've seen the stories. I know we've talked about incentives to get people back into the office. Well, now cities are getting in on the action and they're offering cash incentives for you to come move to their locations. And no, I'm not talking about Miami or New York. I'm talking like Tulsa and Terre Haute. You could get anywhere from $5,000 to maybe $12,000 for some of these cities to relocate your family and work from their city.
How long do you have to stay? And can you do more than one city at a time? I need to know some details here. And I would like the list itemized. If you have it, Martha, I would enjoy seeing that list to see if there's a side hustle to be had from living your life like Bob Seger used to, like going on a tour of all these cities, having a T-shirt made up, right? Tulsa, Oklahoma, April 12th. Omaha, Nebraska, April 14th. Kansas City, April 17th. If I can get $5,000 at every stop, maybe I'll get a tour bus.
You could be like the 2025 Johnny Cash, that I've Been Everywhere song.
Love it.
You guys are trying to game the system. With that, we will close. Thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. If you like what you hear, subscribe and rate the podcast and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.